One of the calculations we usually have to do when recording entries related to pensions is we have to consider the amortization of prior service costs. So when a company either initiates or amends a defined benefit plan, the company may provide benefits to employees for years of service before the date of that initiation or the amendment to their pension. So it begs the question, should a company report the expense for these prior service costs? Well, the FASB says no. Their argument is that the employer would not provide credit for past years of service unless it expects to receive benefits in the future. So as a result, the company should not recognize the retroactive benefit as the pension expense in the year they make an amendment. Instead, and this is what you see that's in bold on the screen, the employer should initially record the prior service cost as an adjustment to other comprehensive income, and then the employer would recognize the prior service cost as a component of the pension expense over the remaining service lives of the employees who are expected to benefit from this change in the plan. Okay, so the cost of the retroactive benefit, including any benefits provided to existing retirees, is the increase in the projected benefit obligation at the date of the amendment. All right, now, companies will rely on actuarial services to compute the prior service cost, but the amortization of the prior service cost is the responsibility of the accounting function. Now, FASB indicated that the preferred method would be a years of service method, and I want to illustrate that next. Okay, so here's an example. We've got the Zarl company. They have a defined benefit pension plan covering 170 employees. In negotiations with the employees, Zarl amends its pension plan on January 1st, 2015, and it grants $80,000 of prior service costs to employees. The employees are grouped according to expected years of retirement. So we look at the number of employees. There's 170, and they have the expected retirement that you can see on the screen right here. Okay, so 40 of them are expected to retire at the end of 2015 and so forth. Now, if we're going to calculate the annual prior service cost amortization, we would have to produce this schedule here. So what you do is you list the groups and you list the service years by group. And what you see is when we have more than 1 year, we just repeat the service year. So for group B, we've got 2 years to consider. We put 2 down. For group C, there's 3 years to consider, right? It's depending on the timing of where we at and how many years until they retire. And you run through these numbers to come up with a total service years. And then we've got to do a calculation. It says computed on the basis of prior service cost of $80,000, a total of 500 service years, right? There's our 500 service years calculation. The $80,000 was given. We have to determine the cost per service year. Okay? Now, let me illustrate how you would do that. I'll move this off the screen for you. You can see the solution. Okay, the cost per service year is $160, and how we calculate that is we simply take the $80,000 divided by the 500. Okay, now once we have that, we can determine the exact amount of annual amortization we need to make per year. Now, you may have the question, how do we come up with 130, 110, 70? Well, what we're doing is we're subtracting out those employees that were expected to retire in previous years. Okay? So we had 170 at first, by the end, then 40 retire, so 170 less 40 gives us 130 for the next year, right? Then how many more retire? 20 retire, so we go down to 110, then 40, okay, and we work our way down. That's how this works. And you need that amount as you work up your pension entries on the pension worksheet. One last point I want to make is that there is an alternative method of computing amortization of prior service costs that you could use. You could use the straight line amortization method. Now in this case, we've already computed 500 service years and 170 employees. So what you can do here is take the 500 service years divided by the employees, so you've got an average per service year of 2.94, and then you would simply divide the 80,000 by 2.94 to come up with the annual expense. And this method is permitted as well. It's considered to be, well, it's the straight line amortization method versus the more of activity-based method, which is similar to some activity methods of depreciation and amortization you've probably studied in the past. Okay, so I hope you found this helpful.